All right, today we're going to build a framework for wealth. Not some get-rich-quick scheme, but a durable system that's designed to last. We're going to move way beyond just saving money and really dive into the world of strategic investing. My goal here is to give you a playbook, a system for making your money truly work for you, and it's all built on 4 essential pillars. Ready? Let's dive in. So here's the game plan. We're going to start with the most important piece of the puzzle, your mindset. From there, we'll break down each of the 4 pillars, understanding what an asset is really worth, reading the psychology of the market, turning your investments into income generators, and of course, protecting yourself from the unexpected. Then, we'll pull it all together so you can start building your own financial fortress.
Look, before we even touch a stock, a bond, or a business, we have to start right here, with the 6 inches between your ears. The single biggest shift you can possibly make on the road to wealth is moving from thinking like an employee to thinking like an owner, like an investor. Everything, and I mean everything, is built on this foundation.
So what's the real difference here? Well, the employee mindset is all about the paycheck, right? It's about a good job, a steady income, benefits. You're literally trading your time for money. An investor, though, they're focused on one thing: acquiring assets, things that make money all by themselves. Say, instead of working for money, the whole goal is to build or buy systems that make money work for them. And to pull that off, you need 2 things: financial education to know a good opportunity when you see one, and the buying power to actually do something about it.
This quote from Robert Kiyosaki just nails it. You can have a massive salary, but if it's all flowing out to pay for cars and houses and other liabilities, you're not building any real wealth. Wealth gets built in the asset column. It's about what you buy and hold, what you keep that keeps on paying you. So, with that owner's mindset locked in, let's jump into the first pillar you're going to use to get those assets.
Pillar 1 is all about fundamental analysis. This is you being a detective. It means looking right past the daily stock price wiggles and all the media hype to understand the real, intrinsic value of an investment. It doesn't matter if it's a company, a piece of real estate, or even something like water rights. Fundamentals are all about figuring out the underlying health and strength of the thing itself, completely separate from all the market noise.
And if you want to see what happens when you ignore fundamentals, oh boy, just look at the Japanese real estate bubble. Back in the mid-'80s, you had easy credit fueling this insane buying frenzy. With tons of demand and not enough houses, prices went to the moon. But this wasn't based on the actual value of the properties. It was pure speculation. Well, around 1990, those adjustable rate mortgages reset, and suddenly, the party was over. Payments shot up, people had to sell, and a flood of houses hit a market where nobody was buying. The crash was epic, and it wiped out fortunes. That's what happens when you ignore what an asset is truly worth.
So how do we stop that from happening to us? Well, we use tools. And one of the most classic tools for fundamental analysis is the price-to-earnings ratio, or PE. Put simply, it just helps you figure out if you're paying a fair price for a company's profits. A really high PE might mean a stock is way overpriced. A low one could be a bargain. Of course, you always have to compare it to others in the same industry. For instance, a new ag tech company might have a high PE because everyone's excited about its growth, while a boring old utility company would have a much lower one. It's basically a crucial reality check on the price tag.
But here's the thing. Fundamentals go way deeper than just one number. This example shows you why. Take a look. Both companies look identical at first glance. Same PE, same growth. But there's a killer difference. Company A grows without breaking a sweat and pays out all its profit to you in dividends. Company B has to reinvest every single dollar it makes just to hit that same growth target. So, which one is more valuable? It's Company A, hands down. You get that cash to go reinvest anywhere you want. With Company B, all the profit is trapped. That's the power of digging into the fundamentals. Okay, now for our second pillar, technical analysis. If fundamentals are about the value of the asset, technicals are all about the behavior of the market. This is where you learn to read the story that price charts are telling you, to understand crowd psychology, and to get a feel for how investors are thinking about a sector, like, say, agricultural technology right now.
I love this analogy because it's perfect. Think about bottled water. Years ago, if you told someone you were going to pay for a bottle of water, they would have laughed at you. Water is free. There was resistance to the whole idea. But slowly, over time, the market's perception changed. People decided that, you know what, convenience and purity do have value, and a price that was once crazy became totally normal. That collective shift in psychology is exactly what technical analysts are looking for.
So how do investors actually read these signals? Well, one way is by looking for support and resistance levels. You can think of these as historical floors and ceilings on a price chart where buyers or sellers tend to show up. They also watch for something called sector rotation. When you see big money flowing out of, say, tech stocks and into something like ag tech, that's a huge clue about where sentiment is shifting. And then, of course, you have news. A bad earnings report or a big announcement can cause a stock's price to jump or drop overnight as the market instantly reevaluates its worth.
On to pillar 3, and honestly, this one is a game changer: cash flow. This is where we stop just hoping an asset goes up in value and start actively engineering ways to get paid from the assets we control. This pillar turns your portfolio from a static number on a screen into an engine that is actively paying you.
Let's make this super simple. Think about the difference between flipping a house and renting it out. The flipper is playing the capital gains game. Buy low, hope the market goes up, sell high for a one-time profit. It's almost completely dependent on the market. The landlord is playing the cash flow game. They're using the asset itself to generate a predictable, ongoing income stream every single month. One is a one-time event, the other is a continuous engine.
You know, this idea is literally ancient. One of the very first examples we know of comes from the Greek philosopher Thales. He figured out a massive olive harvest was on its way. But he didn't buy up all the olive groves. No, he was smarter. For a small deposit, he locked up the rights to use all the olive presses in the area. He didn't own them, he controlled them. And sure enough, the huge harvest came in, farmers were desperate, and Thales subleased his rights for a massive profit. That is the essence of an options trade, using a little bit of capital to control a valuable asset and generate cash flow.
And this isn't just some dusty old story. The master himself, Warren Buffett, does this all the time. When he sells put options, he's basically acting like an insurance company. He collects a premium, that's cash in his pocket, today, in exchange for a promise to buy a stock he already likes at an even lower price down the road. He literally gets paid to wait for the exact bargain he wanted in the first place. It's an incredible way to generate a constant stream of cash.
Okay, this brings us to our final, and you could argue most important pillar: risk management. A lot of people think investing is all about offense, all about making money. But the pros, the really great investors, they know that playing defense, protecting what you have, is just as critical. You have to learn to expect the unexpected.
Let's talk about the turkey problem. It's a little dark, but it makes the point perfectly. Imagine you're a turkey. Every single day, a friendly person comes and feeds you. For 1,000 days straight, you get food, you're protected. Based on all the data, you become more and more certain that this person is your best friend and life is perfect. Your confidence is at its absolute peak the day before Thanksgiving. This is a black swan event, a risk that is completely invisible because it's outside of all your past experience. Investors who only look at past performance are setting themselves up to be the turkey.
So, sophisticated investors don't think in terms of high risk, high reward. That's a coin flip, where what you can lose is just as big as what you can win. They hunt for something different: asymmetrical bets. They use a framework you can boil down to this: heads I win, tails I don't lose much. They look for investments where the potential upside is massive and the potential downside is small, known, and totally manageable. It's a completely different game.
So how do you actually build this defense? Well, you've got a whole toolkit. Hedging is basically buying insurance for your portfolio. A put option, for example, can protect your investment if a stock you own takes a nosedive. Then there's asset protection. This is about building legal firewalls. Holding your investments inside an LLC can shield your personal stuff if the business gets sued. And of course, there's the classic: diversification. You know, not putting all your eggs in one basket, so that if one investment goes bad, it doesn't sink your whole ship.
Okay, so we've covered all 4 pillars. Now, the final step is to understand how they all lock together to form one single system, a financial fortress that you are in command of. This is all about your personal journey from here.
Think of your financial education as a path. Most people start in a state of ignorance. Their money's in a 401k or with an advisor, and they really don't know how it works. But just by watching this, you've already made the huge leap from ignorance to awareness. You now have the framework. The next step on this journey, the goal, is proficiency, the point where you can confidently use these pillars to analyze opportunities and truly architect your own financial future. And here it is, the most important takeaway. These pillars are not a checklist, they're an integrated system. Your fundamental analysis tells you what to buy. Your technical analysis helps you figure out when to buy it. Your cash flow strategies can actually pay you while you hold the asset. And your risk management plan protects you from a catastrophe. See, each pillar supports the others, creating a powerful and resilient approach to building wealth.
So I'll leave you with this one final thought.
Having a job is like carrying buckets of water. It's hard work, and the second you stop carrying, the water stops flowing. An investment portfolio built on these 4 pillars, that's like building a pipeline. It takes work up front, for sure, but once it's built, it delivers money to you automatically, whether you're working or not. So the question is, are you ready to stop carrying buckets and start building your pipeline?